Happy New Year, everyone. I hope the holiday season treated you well and you're ready for a big year in commercial real estate. This week, I'll highlight 3 reasons the commercial real estate investment market should revive this year. Of course, everyone who's active in the commercial real estate market is well aware that transaction activity slumped last year. Depending on how you measure it, sales were down by 20 to 25% compared to the average number of transactions between 2014 and 2019. I use those years as a baseline because commercial real estate sales activity was pretty consistent over that span. But I anticipate we'll see a recovery in 2024. Maybe not to the levels we saw in 2021 or 2022, which were abnormally active, but certainly moving back into alignment with where we were before the pandemic. The first reason I believe commercial real estate activity will revive is because the economy has proven to be more resilient than many expected. The consensus baseline economic forecast now calls for a soft landing, with comparatively low recession risk in most predictions. We're on the backside of the inflation curve, with virtually all key inflation measurements showing significant declines since they peaked in mid-2022. In addition, job creation remains positive, but it has slowed steadily over the course of the last year. That trend aligns well with the soft landing scenario. Our current forecast for job creation in 2024 is 1.7 million jobs, and we expect the unemployment rate to remain range-bound near 4%. On top of that, a variety of other indicators remain modestly positive, including inflation-adjusted core retail sales, service industry metrics, consumer sentiment, and corporate profits. So basically, the economy should give commercial real estate a modest tailwind in 2024. But more importantly, the generally positive outlook will help alleviate uncertainty and moderate caution levels among investors. That psychological dimension is absolutely key to a market recovery. The second reason I believe commercial real estate activity will revive is because interest rates have started to come down. And the broad-based expectation is that they'll continue to move lower over the course of the year. The 10-year Treasury peaked at about 5% in October last year and has since come back down to the 4% range. And at the Federal Reserve's meeting in December, Chairman Powell suggested rate reductions could begin this year even before inflation reaches the Fed's 2% inflation target. At present, Wall Street has placed a 60% likelihood that the Fed will reduce rates by 25 basis points to 5% in March. By June, there's a 50% likelihood the overnight rate will be reduced to 4.5%. By September, Wall Street is placing 80% odds of rates being 4.25% or lower. And by December, Wall Street believes the Fed funds rate has an 85% likelihood of being 4% or lower. Now remember, those probabilities change by the day, sometimes by the hour, or even by the minute, so they're not set in stone. But they do give a good general perspective on where Wall Street investors are putting their money based on the current outlook. As the cost of debt capital comes down, it will help close the buyer-seller expectation gap, supporting investment activity. And unlike in 2022 and 2023, when rising rates were derailing deals, falling rates could bolster deal flow. The third positive force supporting commercial real estate investment activity is the sheer volume of capital that's waiting to be placed. Approximately $240 billion of capital targeting commercial real estate is awaiting entry to the market. That's close to the record level set in 2021. Of course, it'll take time for the capital to be placed, and sales activity will likely ramp up over the course of the year. But by the second half of 2024, activity levels may be back in alignment with the pre-pandemic norm. Granted, this outlook is pretty optimistic, and it assumes that nothing disrupts the main drivers, but there are always risks. The Fed could hold rates too high for too long. There could be a government shutdown at the end of January. Additional geopolitical conflicts could erupt, or existing ones could spread. Those are just a few of the things that could go wrong. But for now, it looks like we've cleared most of the hurdles that disrupted the market last year, and the investment climate is improving. That said, investors always need to monitor the numerous forces in play and keep their eyes on the horizon.